This program brought to you by eChoice, helping thousands of Australians find the right home loan since 1998.
Hello and welcome to Money Talks, where our goal is to make you richer. Nothing more complicated than that. And tonight, I'm going to give you the straight talk on what is really likely to happen to house prices in Australia. To do that, we'll pick the brains of Chris Richardson, the head of Deloitte Access Economics, and later we'll look at the potential for other parts of the property market. If housing is set for a rough time, are there better property plays than, say, commercial or industrial buildings? And if so, how can individual investors get a slice of the action? Okay, let's get straight to Chris Richardson, who's not just an economics number cruncher, but has in the past had a lot to do with the property sector. Chris, welcome to the program.
Thanks.
And correct me if I'm wrong, old memories can play tricks on me, but you used to have a lot to do with the property sector in Australia, didn't you, in terms of forecasting and things?
Yeah, and we still do in a whole bunch of ways.
Okay, right. And you wrote, well, you were at least quoted in a newspaper last week, taking what I thought was a very realistic view on what house prices are going to do, because there's been some very scary headlines, 40% falls in house prices. What did you think when you heard that headline?
Oh, 40% no. So what is happening is housing prices in Australia is falling, but that had to happen, and they're falling at a time when the economy is strong. That's actually the secret sauce of the moment. You don't want housing prices falling when the economy is weak, and those two things feeding off each other. What we're getting at the moment is unusual, but it's very welcome. The economy, arguably the strongest that it's been since 2012. Housing prices falling.
So look, I think even during the recession of 1990-91, we didn't see 40% house price falls, did we? Yeah, across the board. Some suburbs, some like Gold Coast probably had some big falls like that. And I don't know, in the GFC, I think Palm Beach had like 20-30% falls in Sydney. And I've seen recently, 2 years ago, Middle Park went up 40%. Now, if it goes up 40% one year, you expect it to pull back maybe 20% in 1 year as a consequence of what's going on. But to average it out, from peak to trough, what would you think Sydney and Melbourne is likely to face?
Look, somewhere between 10 and 15%. Which effectively means that from where they already are, that's another 5 to 10% in terms of price losses. You're right. They went up a long way in the first place. Across a long period of time, housing's been the best investment in Australia, certainly amongst large investments. It's risen more. It's been less volatile in doing that. It's been a lovely investment. But I would have some caution beyond the sort of short-term falls of another 5, maybe another 10%. Chances are we go through a flat period, and property's done that before too, while it gets a little closer to its fundamentals. I'm not going to be surprised if in 5 years' time housing prices in Australia aren't that different to what they are today, and I'd be happy about that.
And Sydney basically went for, was it about 10 years going sideways, Chris? Inflation rise at the very best?
Yeah. And it happens, and Sydney is more at risk of that than anywhere else because its increases have been more spectacular than anywhere else. It has a whole range of other implications, though, including the fact that given that Australian families, as we went as a nation from a China boom to a house price. The Reserve Bank cut interest rates as China slowed. That showed up very, very much in housing prices. But it also means that the Reserve Bank now has absolute fingertip control of the Australian economy. It does not need to raise rates much to rein in the economy, because we now have families in Australia with debt-to-income ratios that are the second highest in the world.
Okay, so in a sense you're arguing that we have a really certainly a Goldilocks situation, that the economy is a lot better than doomsday merchants are predicting, and I suspect you think this improved economy has legs for at least 1 or 2 more years?
Sure. Tick off the things that are going well. Growth is the best that it's been since 2012. Unemployment rate at 5%, lowest that it's been since 2012. Income growth more broadly in the Australian economy is pretty good. That's not yet. It's showing up much more in jobs than in wages, but those two will slowly trade places. Wage growth will pick up as job growth falls away.
Yeah, and the doomsday merchants like to say, oh, wages aren't going to increase. Your argument is they will increase, not probably at the rate in which a lot of people would like them, but if wages do rise at a good rate, it's less chance of maybe choking off the recovery. Is that a fair call?
Yeah, and in a sense, that's the scenario in which Goldilocks continues. There are things that people are too worried about, most notably the trade wars. Now, we've modelled those, and, trade wars might be really dumb, but they're not particularly dangerous, not that dangerous for the world as a whole, and not that dangerous for Australia, which doesn't mean that individual businesses don't get hit. It's more of a problem for China, a direct victim, if you like, and there are, risks that confidence or a weakening in confidence gets a roll on there. But the basic outlook for Australia's economy, growth remains a little better than average, and that keeps unemployment headed ever so slightly down.
Obviously, you don't specialise in the stock market, but you're not the kind of guy who ignores important implications for the economy. What do you think's going on with the stock market now, and do you think has a potential to impact on the growth outlook for the Aussie economy?
Look, the good news is that share markets and economies are much more divorced from each other than I think people think they are. We are living through a phase in which the cost of borrowing has never been cheaper. As a result of that, the value of all sorts of assets, you've seen it in share markets, you've seen it in housing markets in Australia, you've seen it in most markets, asset prices are really high. But finally, and goosed along by a big tax cut in the US, you are seeing interest rates rising and markets expecting that to continue in the US. That's finally, you've seen the penny drop, I think, with markets that money's not going to stay as cheap. That brings a bunch of valuations off. The US was always more at risk of that than Australia, but we can't ignore what's happening in those American markets.
Okay, so in some way, Chris, we've got house prices will fall, but not as badly or scarily as many headlines say in newspapers. You've got wages growth on the improve. You believe economic growth will still stay around the 3% mark. Unemployment to keep falling. Okay. Is there anything bad out there that people should be worried about? And even the budget deficit's coming right down to
it has. We're basically back to the zero line. We're not in surplus, but we are no longer in deficit. You are seeing the tax take in the Australian economy rise at 10% rates of annual growth at a time when national income is broadly at 5%. So the combination is good. It is fair to say that the economic backdrop, the political backdrop, even in a sense the technological backdrop is more volatile than it used to be. So the most likely outlook for Australia is pretty good, but the most likely outlook is a little less likely than it used to be.
Well, let's make you become an economist again, because it's something you've had to persevere with most of your life. The Economist Intelligence Unit tips a US recession 2020. Goldman Sachs says 2020. What do you think?
And Deloitte in the US says the chance of recession 2020 is about a quarter.
It's still small, quarter, isn't it?
Well, sure. Now, having said that, what you've got is a big sugar hit running through the US. And as that sugar peters out from the economy, there are going to be risks around that. I don't expect, and Deloitte in the US does not expect a recession, but you will clearly see growth start to fall away. We already saw it, Friday night, our time. Growth still magnificent in the US, but off its peaks.
Okay, so one last one, Europe. Europe had a good outlook recently. They've kind of downgraded it, but I have seen other forecasts saying that they expect there could be a rebound. What's your view on Europe?
So as an economy, Europe is coming together. It is, however, once again, the politics Italy is much, much bigger than Greece in that vast game of political chicken around Italian debts and deficits. There are some risks there. Ignoring that, you know, if that all goes fine, then the European economy also fine.
Okay, and you don't find Donald Trump an economic parameter you find easy to interpret?
No, but it is probably fair to say that politicians are less important for economies than we think they are. And you know, trade wars is a great example. Magnificent headlines, but not terribly big impacts on overall economies.
Okay. Now, Chris, if people want to see what you write, can they go to the Deloitte website and get you in, you know, technicolor and deep detail?
And beautiful detail. So the basics of what we're saying is indeed on the Deloitte website, and we have greater detail available at a price. We are economists.
But of course, thanks for joining us.
Thanks, Pat.
That's Chris Richardson from Deloitte Access Economics. Now, coming up after the break, we have Bell Direct's Julia Lee and her hot stock of the week. Welcome back. Each week, Bell Direct's Julia Lee pinpoints a stock she likes. And this week, we're heading to the consumer discretionary sector, which is quite relevant, isn't it, Julia? Thanks for coming on the program, as always.
Always a pleasure.
It's quite relevant. We were talking about residential house prices coming off the boil, and a lot of companies related to the housing sector are struggling at the moment.
Absolutely. I mean, I like to think of most of the market as moving in cycles. I mean, most things in life move in cycles. Yeah. And particularly the consumer discretionary sector, where most of the retail stocks sit, they go up and down together with the economic cycle. So the Harvey
Normans, JB Hi-Fi's, Nick Scali's, there's all discretionary staples like Woolworths and Coles.
Absolutely. I mean, the consumer discretionary sector is a little bit strange because it also includes things like automobiles, as well as travel, as well as the retailing space. But, you know, Pete, think of any stock to do with the housing market or related in any way, and you've probably seen the stock down around about 10% or even more in October, whether it's something like Nick Scali or Boral, which is in the building products area, or even a Stockland.
And you relate it to house prices. You think people are reacting to the excessively negative headlines by my colleagues in the media and are starting to get worried.
Yeah, well, first of all, there are those items which are related to housing and the construction of new housing, so building products. And then there are the parts to do with housing, like plumbing products, like RWC or GWA, which is more toilet type of products. And there's this furniture. If you buy a new house, you know, you want the new carpet, you want the new lounge.
And money's tighter. Banks are lending a lot harder now than they did before the Royal Commission.
You're seeing the banks having to do a lot of work to try and get that mortgage lending. I mean, for years we had double-digit mortgage lending growth. So, look, the wealth effect is certainly having an impact in the retailing space. And we have seen a number of downgrades over the last couple of weeks. Or soft commentary. We've seen Flight Centre, we've seen Michael Hill Jeweller, we've seen today Kogan coming through with some steep falls of
what was he down, 20-something%?
32%.
32%.
And we saw BWX, we saw Bellamy's as well. So some of the baby formula products are coming under a bit of pressure, and some of those baby products. So, you know, a bit of cautiousness when it's coming to those cyclical areas, which are either related to housing or either related to retail, and especially retail, because it's ahead of the most important time of year for retail.
And we get retail numbers on Thursday, by the way.
We get retail numbers on Thursday. Christmas trading period, where the bulk of the profits for the half.
Okay, let's hope house prices don't steal Christmas on us. Is there a company that you like that you think looks like good value amongst all this retail negativity?
There is a stock I really like. This one is Baby Bunting. BBN is the stock
Why would you be interested in a company like that?
Well, you know, I did go to Baby Bunting on the weekend to try and pick up an extra car seat. But look, it's great when 4 of your major competitors disappear off the face of the earth.
Like who?
We've seen Baby Bounce, we've seen Babies R Us, and a couple of other major competitors in that area go absolutely belly
Because they did very well about 2 or 3 years ago, didn't they? I remember Charlie Aiken had babies at the time as well. He was going there all the time and he was tipping it.
I'm telling you, $1,000 prabs. And look, you don't want to buy these things through the internet. You want to test drive them. So bricks and mortar stores, I think, actually have a place.
Okay.
And importantly, in terms of Amazon and the growth of Amazon, they don't stock some of these key brands like Bugaboo or Britax. You actually have to go to a Baby Bunting or the similar to try and get these type of
I won't
items.
ask you where Bugaboo came from, but certainly a child can make you say that on many occasions. Now, so your view is that Baby Bunting looks well positioned.
It looks
greatly
positioned.
What's his current share price?
At the moment, the share price is, let me check.
I've caught you out here. I'm sorry, Julia.
I can't read that, but it looks like it says around about $4. But having a look at Baby Bunting, look, the shares have already gone up. But when you do see a lot of competitors go belly up, in the short term it's a negative, and that's because you get liquidation of stock.
Right.
But in the medium to longer term, you know, margins are good, you get to take over that market share and you get to expand your footprint. And really the combination that you want to see in retail is organic growth coupled with store rollouts, and that's what Baby Bunting's trying to do. From 47 stores to 80 stores, their competitors are gone, they're going to dominate this area.
And do you think house prices affect the rate at which babies are born in Australia?
You might be spending more time at home.
That's a good point. That's a good point. That's a very good point. Julia Lee, as always, a fantastic piece of analysis. And if people want to know more, you actually put this on my website tomorrow as well.
Yes, I go to switzer.com.
Yeah, and you write it all up. Thanks, Julia.
Thanks.
That's Julia Lee from Bill Direct. Now, coming up after the break, we have 2 other players in the property sector. So residential might be under a bit of stress, but what about industrial and commercial? We'll be talking to Tim Johansen from Qualitas and Jason Huljich from Centuria. That after the break. Welcome back to Money Talks. Well, residential properties are under pressure, especially in Sydney and Melbourne, as Chris Richardson was pointing out. And the media coverage is not helping. But what about other property players? Jason Huljich is Head of Real Estate and Funds Management at Centuria, and Tim Johansen's MD at Qualitas. Now, both play in the commercial and industrial space, and Tim's also in residential as well. So let's just see if there are buying opportunities away from the overcooked and what I think is excessively terrorised residential housing sector. Jason, Tim, thanks for joining us on the show. Let's kick off with you first, Jason. Yep. So explain what the listed vehicle Centuria does.
Sure. So our main listed vehicle is Centuria Capital.
Yep.
So it's a $5.5 billion asset manager, and about $4.6 billion of that is real estate. So we've got 2 listed REITs, an industrial REIT and a commercial REIT. And we've got 16 unlisted funds that mainly invest in commercial real estate.
Okay, so if someone was trying to understand what they're investing in, give us an example of one of the funds that you're talking about and what they actually invest in.
Okay, so for our unlisted funds, we'll go buy a high-quality office building, say for $100 million, and investors can come in and invest into that for a fixed term, usually 5-year term. They'll receive their share of the rent off that property every month, and we'll manage the property and try and add value so they can get a capital gain at the end as well.
So it's like pooling everyone's money together, and then you make the decision. I guess you show them the building you want to buy.
That's right.
And then at the end of the day, rents come in, so they get an income along the way. And if you work it out right, there's capital gain after 5 or 6 years or something, you sell it.
That's right.
And you split the income, you take your profit and whatever.
Exactly. Or they can come into listed vehicles where it's traded like a share that has a portfolio of 30 or 40 assets in it, and they can sell or buy on the market like an ordinary equity.
Okay, and that's where you guys are taking that money and using it in other investments, industrial, commercial ways.
Correct.
But people can access through the stock market. Now, Tim, you're slightly different because these guys are sort of doing hard properties. You're in the debt provision for developers and people buying buildings and whatever. That's right. In a sense, you're competing with the banks to supply money, but people can also invest in yours on the stock market as well. So explain how that works.
Yeah, so Qualitas, we're a real estate investment manager. We've been running for 10 years, unblemished track record. We've invested in 109 transactions and haven't lost any money. We manage about $2 billion of funds under management on behalf of institutions and high net worths globally and from Australia. We're currently putting together the Qualitas Real Estate Investment Fund, which is listing on the 27th of November this year, and that's a targeted 8% return, payable monthly. And yes, that's a vehicle that we investors will lend into or invest into, and that will lend into the commercial real estate market. So that's lending on industrial properties, commercial properties, retail properties and residential properties.
Okay.
Yep.
Now, you have an exposure to residential, Jason. You don't have exposure to residential?
No, we don't.
Okay. In terms of industrial and commercial, what's your outlook? Because everyone's telling us how bad residential is. What's the outlook for industrial and commercial right now?
It's very different at the moment for commercial and industrial. Both markets are extremely strong. So if you look at commercial, Sydney and Melbourne are driving the way. Sydney's got vacancy rates of about 4.5%, Melbourne's 4%, so some of the lowest vacancy rates on record. Really good rental growth, so 9-10% per annum. Perth and Brisbane are not quite there. After the mining downturn, a lot of their tenant base is mining.
They had excess capacity.
They did. So they had rents going the wrong way, but lately the rent's starting to grow. And then Adelaide and Canberra, it's a two-tiered market. So if you've got the high-quality office buildings, very low vacancy. If you've got the older, obsolete buildings, higher vacancy. But if you look at it as a whole, the average net absorption, which is how much office space is leased per year, across all those markets, about 155,000 over the last 10 years, every year. The forecast is saying this year we should lease about 335,000, so nearly double, more than double, the 10-year average. So it's very strong. So you're seeing a lot, because of these drivers, you're seeing a lot of demand for office space. All the offshore groups, a lot of big onshore groups. We recently bought a portfolio of $650 million a couple of weeks ago. There's 15 groups vying for it. In the end, it came down to us and a Singaporean group. But the big deal that's on the cards at the moment is Chifley Tower. So that's on the market.
That's in Sydney?
That's in Sydney.
Opposite the Sofitel Hotel.
Exactly. Yeah. So GIC, which is the big Singaporean government group, they are selling either a half share or a whole share of that at the moment.
What will the building sell for?
Half share 900, full share close to 1.8 billion. So it'll be interesting to see how that plays out. Yeah. Industrial as well. Industrial's very strong. Cap rates are at the lowest they've ever been. And what we're saying, it's becoming the retail replacement trade. So people are getting out of shopping centres. You know, they're a bit on the nose because of e-commerce. But e-commerce retailers need well-located warehouses to deliver their goods. So we're seeing huge demand for industrial from all the major groups, from Australian REITs, Singaporean REITs, high net worths, private equity. Blackstone's been probably the biggest buyer of industrial real estate in Australia.
So, Tim, when you heard, I don't know if you heard Chris Richardson say that the outlook for the Australian economy, 3% for the next 2 years, that must have made you happy, because what Jason was explaining, the strength of Sydney and Melbourne, it wouldn't be the way if we're growing at 1% or at 1% or in a recession.
No, that's right. And look, I agree with Jason. I think those commercial office markets and the industrial markets are in strong shape at the moment. And you know, in our income fund, we're constructing a portfolio that includes those asset classes because they are trading quite well. But we do mix that with other asset classes as well, including retail and hotel and some residential development as well, just to get that broad coverage.
So in this fund that you're talking about, how many potential borrowers will you be lending money to? Because the more you've got, the more diversification you've got, and effectively the safer you look. Yeah,
look, our raise is between $150 million to $500 million. We've reached our minimum already, so we're underway. And we'd probably, in that portfolio, depending on its ultimate size, probably have 15 to 20 positions in there. So, and that would cover those, geographic diversity across the eastern seaboard, capital cities, asset class, loan type and client type, so good diversity.
And what would be the minimum someone could invest in this fund?
Well, it's a retail offering, so it can be several $100s, right, to several $1 million. It's a illicit investment trust, that's right.
Illicit,
That's right.
Great. Now, just, is there a building you guys have got on the burner now? Because I know in the past you've actually had various buildings. What's the building that you guys have now?
We're actually, on the unlisted side, the only thing we have open for investment is our diversified property fund. So that's always open for investment and it's got liquidity. But obviously the REIT's always open for business. They're both trading sort of around 7% plus. So you can either have invest in the portfolio of office assets or industrial assets and have
But
liquidity.
you haven't got a building on the market. Adelaide was the last one, which is a surprise. You actually took a punt on Adelaide and it's done pretty well.
Yeah, we quite like Adelaide and has done well and was very well oversubscribed. But we usually do probably 2 to 3 of those unlisted single asset funds a year. So there'll be another one coming up shortly.
Okay. So Tim, going forward, how big could this fund of yours become? Is there a limit to what can be accepted in the LIC?
Look, I don't think there is a limit. I mean, we've successfully raised the number of funds in our debt strategies at the moment, and largely through institutional and ultra-high net worth support. And a natural evolution for us has been to go and take this onto the listed scene, because it'll probably be the first of its kind where it's 100% focused on debt. So we see this as one of our key vehicles going forward. We think the 8% target return is attractive in a low interest rate environment.
Is that based on the history of what you guys have been able to achieve?
Yeah, that's right. We've achieved double-digit returns in our debt business for the 10 years that we've been operating. Yeah.
And when it comes to your expected return,
Sure.
What is that based on?
So you have the two REITs have about, the industrial REIT's about 6.8% yielding. This is just coming off the rents of the assets.
That comes from the tenants?
This just comes from the tenants. So we pay the bank debt and then we pay the
Now, I asked you before, does a recession rock you? And you said generally not, because the tenants are good. But you'd also be happy that there's 2 good years of growth ahead at least.
Oh, definitely. Hopefully longer.
Yeah, okay, right. Is there anything else you think that someone who's never played in the space before needs to understand?
Well, look, if you're investing with a manager, as in any investment, you should obviously research what you're investing in, research the track record of the manager, ask around about them before you make your decision.
Okay.
Yeah, look, I agree with that. Our opportunity at the moment is a defensive strategy. It's about lending to people and capital preservation. So I agree with Jason. It's about the manager who's looking after your money.
Thanks, guys. And it's good to see one part or 2 parts of the property market isn't looking as scary as the residential, which I think has been, as I say, blown out of proportion.
Yeah.
Tim, Jason, thanks for joining us. That's the show for the night. Thanks for joining us. If you want to check out what I'm thinking about the market or the business outlook, go to my website, switzer.com.au. And if you want investment selections, you can have a look at the Switzer report as well. I'm Peter Switzer. Thanks for joining me. I'll see you next week.
This program brought to you by eChoice, helping thousands of Australians find the right home loan since 1998.